markets, speculation, and risk. This is the Chat with Traders podcast.
Hey there, how's it going? This is Tessa, your co-host, and you're tuning into Chat with Traders, episode 313. And wow, we're already at the end of another year. What a blessing, though, to be able to say that. I hope 2025 has either been great or full of great lessons and growth for you. Well, let's get straight to our guest. Today, my co-host Ian's conversation is with Doug Colkitt, a quantitative trader who works deep inside crypto and DeFi market structure. This is actually a more technical conversation than most, but it's technical for a reason. We spend time on how crypto markets actually behave when leverage builds up, liquidity vanishes, and liquidation cascades begin. The mechanics that quietly determine who survives volatility and who doesn't. Doug has traded and built systems across both traditional and crypto markets. He worked in high-frequency trading at Citadel during the 2008 financial crisis, later traded futures and volatility products, ran a large market-making operation in international equities, and now focuses on DeFi, perpetual futures, and exchange design. We break down what really happened during the October crypto liquidation event, why traders who believed they were hedged still got wiped out, and how leverage, funding rates, and forced unwinds interact across centralized and decentralized venues. Doug also shares what he's building now in the PerpDex space, including ideas around insurance mechanisms, clearing and market design, and what recent market failures revealed about where crypto infrastructure still falls short. You don't need to trade crypto or understand every technical detail to get value from this episode. The goal is to give you a clear mental model of how modern markets break. So when volatility shows up, you're reacting with insight instead of surprise. We really hope you find value in this episode, and thank you for listening. Ladies and gentlemen, we're so pleased to introduce Doug Colkitt.
Well, tell us a little bit about yourself, Doug. I'd like to, first welcome you to Chat with Traders and find out who you are and what got you interested in the financial markets.
Yeah, I spent most of my career as a quant in HFT in the traditional market. So started out at Citadel in 2008, kind of right when the markets were going crazy. So it was kind of a pretty interesting time to start in finance. Around that time, like everything was kind of collapsing. Besides high frequency trading, especially at Citadel, the group was doing well. It was pretty new then, so I decided to kind of get into that vertical because it seemed like the one thing that was pretty stable in 2008. Did that for a few years, mainly focused on the Asia Pacific markets there, the equity markets. So it was an interesting time, especially like seeing the space grow and kind of develop. Then I left Citadel and decided I wanted to kind of see stuff more from kind of the ground up. So, like at a big firm like that, you're always kind of one piece in a larger puzzle, which is great because the whole machine runs really great. So you can kind of see what the end state looks like, but kind of wanted to build something up myself and see all the moving pieces. And that was a lot more challenging than you would think it is.
First, kind of what attracted you to Citadel and the financial markets in general? I mean, did you study this in school or did you have friends in the industry?
Yeah, I'm a computer science student by background, so I was always kind of more interested in the software side of things. And so this was like kind of as I was like first looking into the industry, like being in school. This was like 2006, 2007. So obviously a big time in the financial markets. A lot of interesting stuff going on, and like quants were kind of getting big. I guess quants were big in the had. But we're getting like kind of really big, especially like derivatives. And so actually technically like my first job on Wall Street was for Citigroup. And so and that was on the CDO desk. So I was just there very briefly. So you get to see a lot of interesting things there. So I saw kind of the whole mortgage securitization stuff happen up close, and then kind of saw the beginning of stuff unwinding there. So But yeah, I guess from my perspective, I was always interested from like the algorithmic quant side. And so being a software person, it was kind of interesting to do like kind of take software and apply it to
Hmm.
markets.
Now, did you trade yourself during that time before your job or while you had that job, or were you allowed to trade?
It was pretty restricted. So very like you could trade some stuff, but you always sometimes you'd get into a position and then it get put on the restricted list, and then you'd have to get get a 30-day approval to get out of a position. So never really put on too much size like trading for myself, at least when I had that job.
What made you decide to move on from Citadel? Kind of like what was the catalyst to want you to go on your own?
Yeah, I think I learned a lot. Like I said, when you're there, you're kind of it's a very efficient machine, but you're just one kind of piece in a larger machine. So you don't really even appreciate stuff like, okay, like just you got to get the market data right. Like you got to data has to be accurate, and you have a whole team of people who do stuff like clean it and source it, and obviously make sure for everyone who's trading that it gets to you really fast. You kind of take that for granted. So I wanted to build out kind of something from scratch from the ground up, which was kind of easier said than done. So I learned a lot kind of doing it from that perspective. So after Citadel, I just started trading individually, built out a high frequency system, mostly focused on the CME and trading index futures and bond futures.
What year was that when you?
I left. So this would be after I had a non pretty long non competes in the industry, are pretty standard. So I started trading for myself in early 2012. Yeah.
And what? Tell us more about that. Well, you were
Yeah, so
trading.
that was
What
that
were
was
you
a pretty
trading?
interesting time. So I'd say, I'd also kind of so mostly focused, like I said, mostly focused on index futures at the CME, and kind of a bit of hubris there because you feel like those are one, if not the most competitive market, one of the most competitive markets. Very liquid, obviously, very active, very competitive. Every major trading firm, is trading ES or one wants to trade a yes if they don't. Nobody's overlooking that one. So I think right, like what you learn is like as a smaller operation with a lot of big fish is like you try to find niches, you try to find things that are overlooked, and around that time, I would say kind of like the bread and butter where could make money was identifying. I'd say things a little bit more complex on, which is like an HFT world would be called like alpha, which just meaning like signals. And there's kind of this inherent trade off in HFT between you want to either be very fast, and when you're very fast you can't do that much you can't do that much computation, right? Computers only go so fast. So if you want to be the fastest person, your signals have to be very simple. Now there's some nuance around there, you can pre-compute things and like all, but like in general there's this trade-off between very simple and fast and kind of more complex signals, but you're slower. And so somebody's faster than you, they get all the easy opportunities. So then you're kind of on the edge, and in some sense you get kind of adverse selection from that end. So I'd say I kind of biased more towards the latter part of that spectrum, a little bit more complex. And the interesting thing there is as you get more complex, you also kind of get different players have different ways that they approach that complexity. So if you can find kind of a niche and like something, certain signals that people maybe they're doing a similar signal, but like nobody's quite kind of constructing it the way you are, like, and then hopefully you're trading, you're kind of trading when things are overlooked, because if you're trading exactly the same time as Citadel, you're not going to be as fast as them, and most of the time you're probably not going to be as smart as them. So you have to figure out a few things you can be smarter than them about, and really lean on those.
Mhm. Um, uh, are you familiar with the famous book by Michael Lewis called Flash Boys, which
Yeah,
painted
yeah.
high frequency trading as front running institutions in microseconds, and then the institutions would get these horrible fills. What were you? So, how accurate was this book? Do you feel from your vantage point?
From my vantage point, I feel like the book, I'm not going to say like high frequency trading is all angels or all beneficial or even right. Like it's a lot of people just making money. But I think the book definitely exaggerated a number of things. I think there are pretty strong, at least in the U.S. markets, pretty strong protections against like outright front running. Some of the book stuff the book like talked about was how you would see a trade at say one equity. So equity markets. I also caveat like I traded futures markets. The interesting thing about futures markets compared to equity markets, from like a microstructure standpoint, is all the futures trade at one venue. So like when you trade ES, they all trade at the CME. When you trade like when Microsoft trades, MSFT stock, it trades at NASDAQ, it trades at NYSE, it trades at, a bunch of other venues. So I think one thing the book identified that's probably like the most accurate is like, okay, if you have a big trade come in and someone hits like NYSE and they can see that there, you can kind of do a certain type of front running where, okay, someone goes to NASDAQ, sees a trade at NYSE and they know, okay, there's probably more trade coming to NASDAQ, and someone who has a faster connection can kind of hit liquidity there. But that definitely doesn't apply to the guy sitting at home trading on his Robinhood account. Those are kind of institutions versus institutions. So I do feel like the book was a little bit exaggerated in terms of some of the stuff.
I see. So do HFTs actually help the smaller trader because they're competing with each other to cut in front of each other to give the smaller trader a better fill?
That's a great question. I guess I'd say the answer is it really depends. I think like the base case they do, right, like they do compete, right, like so when markets are based on price time priority. So if you're a market maker and I'm a market maker and I want to get fills, I better quote a better price. I better put a better price than what you're providing, right? So like there should be right, like that is the base case. There should be competition. The more kind of market makers are in there, they should compete on price. Does that happen all the time? Not completely, because there are a lot of nuances here. First thing is like tick size, right? Like there are you can only quote so tight in a lot of markets, and a lot of markets are just that tight all the time. So if it's like that, I can't improve on your price. All I can do is try to be you go to the second part of that price time priority, I can just be faster than you. So a lot of times HFTs, and this is why like a big reason latency is important, is we both want to be the first people at a new price, because it's just a lot better to be first. Your fills are better as a market maker. You have less toxicity. So does that really add anything? Not really. It doesn't really hurt people, but like it's just kind of we're competing for the same rent. And if one of us disappeared tomorrow, it's not like consumers would be a lot worse off. So that, and then like HFTs do, they're not all market makers. A lot of HFT is actually taking liquidity, right? I'm trying to hit quotes. When the price moves. And to be honest, right, when I was in HFT, as an individual, at least that phase of my career, most of what I was doing would be liquidity taking rather than market making. And you're basically trying to see liquidity and be the price is stale, or you think a price is about to move, be the last person to kind of hit a price before it goes up. That's, I don't know how much that might actually be harmful for consumers, right? Because it makes the job of market makers tougher. Market makers widen out their spreads. Everything's more expensive. So, like a lot of things, it depends. It depends. The answer more complex than it seems.
Right. So a decade later, after the book, has HFTs evolved to the point? Are they a little more benign now, or?
Yeah, I'd say it's definitely the biggest thing that's happened since that book is things have moved off lit exchanges to internalizers, dark pools. I mean, that was definitely happening during the book, and actually spent some time at Citadel doing that on the kind of very early when Citadel was buying order flow and internalizing that. But even today, I think it's more to a certain like even more extensive, is that most stock trades don't even happen on a stock exchange, right? They just get routed to an internalizer or a dark pool, and somebody fills it, right? Because The average, we'll call like segmenting order flow, like that's very profitable for market makers. If I know who's sending me the order flow, I can provide, I can provide a lot better price to the average Robinhood trader than I can provide to, somebody who's very sharp flow or, very sophisticated. So, as you can go up, if you go upstream and you can see where the order flow is coming from, you can kind of be more aggressive on your pricing. And so, kind of, you don't want, I think the equilibrium is like most order flow doesn't hit the stock market because the stock market is anonymized by its nature. So I'd say it's almost like it's become less of an HFT market. It's just more. It's much more. That's much more of a deal market, right? Like you're a big trader. You got to go to the brokers. You got to make deals. So it's kind of more institutionalized from that perspective. It's definitely harder for somebody who's coming in as an individual or like a small team to make it. Definitely a lot of consolidation into a few big firms.
So let's transition. Tell us a little bit about trading VIX futures.
Yeah. So like I said, that was ES was a very competitive market. And at some point, it got too competitive for kind of just a single guy to make money there. And so this was right around like when the VIX complex ETFs were getting off. Well, I guess they've been there for a while, but like VXX, XIV, those were like really popular 2015, 2016. XIV, and there were kind of a lot of inefficiencies in VX futures. There were a lot of inefficiencies in that whole complex. So kind of transitioned more towards what I'd call like a medium frequency trader in those markets. So that was pretty interesting. I think there was just a massive amount of retail interest in those markets for a while. It was like everyone had like some theory about how to trade VIX, and I think a lot of people got bit by it. But yeah, I mean, it was really interesting, especially around like Brexit and stuff, and then when some of the ETFs blew up, and so a lot kind of yeah, those are definitely I think a lot of people got bit one way or another. Luckily for never got really hit hard, and it was pretty good trade for a while. There were a lot of very obvious inefficiencies. A lot of those ETFs were just massive amounts to the market. I think it would be something like 80-90% of the open interest in the VX futures, and then they had to mechanically rebalance at certain times of the day, right? Like so if you're XIV, you have to stay 1x short. If your UVXY was like 2x, so it had to so you'd have these huge trades and they'd happen at the same time every single day, and everyone would kind of know them ahead of time, so it's kind of very easy to for a certain period, very easy to kind of see, okay, this is, the X futures are going to move up or down at a certain point. So, yeah, when you get a market like that, you should definitely, it's not going to be like that forever. So my advice for any trader who finds himself in like a market like that is definitely size up and kind of take advantage of it while it's there, because you don't know how long like these alphas are going to last.
So I understand that you got into trading Turkish equities. What attracted you to that market, and what were the unique challenges there?
Yeah, so I wanted to go back. So did the kind of the VIX thing for medium frequency trading for a while. I wanted to go back to something more classical, like high frequency. Kind of missed the excitement of kind of trading, microsecond level trading. Also kind of going back, like it was always been like a computer science software guy, and high frequency trading has a lot of just interesting things trying to push the edge of performance. So wanted to go back into that world. At the time, like I'm still now, right? Like the major US markets were very, very competitive. So hard for someone, an individual or a small team to compete. So I was looking for kind of markets that were large enough that would still make sense to trade. If the market's very small, you might be the best person, but maybe you make $10 a day. So it's not not worth it, or at least without like on that high frequency profile. If the market's very large, it's going to be competitive and the biggest players are going to be there. So it's kind of just looking, kind of thought, exactly. Actually, at the time, I was looking at both at like crypto was kind of getting larger, and looking at different emerging markets. In retrospect, probably should have done crypto because it would have kept getting larger, but that would be later. Yeah, I mean, I was looking at a bunch of different emerging markets. Turkey had made a lot of sense because it was just had recently transitioned to like a fully electronic stack. So okay, that's something you can do as an electronic trader. and kind of met some local partners there who kind of had kind of knew the layout, had connections with local brokers, kind of all that other stuff, can handle the business regulatory side of it. So yeah, we started at a market making operation. So that was also somewhat of a different move. Like I said before, I was mostly on the taker side of liquidity back when I was trading the CME. So this was as a market maker. We were actually a pretty large percent of the market. At one point, we were, if not the largest, close to the largest market maker in Turkish equities. So yeah, we did that for a while. The funny part is like as an HFT trader, you really know nothing about the stocks that you're trading. So there are still pickers that I remember vividly, for either up or down days. But to be honest, I don't even know like what the companies did. So when you're an HFT trader, you just look at like order book and charts and flows and kind of all the other stuff. And so whether you're trading Turkish equities or cryptocurrencies or ES futures or bonds, it's all kind of the same thing. Which is the nice part about like HFT. It's all kind of the same thing regardless of what you're trading.
So tell us about what attracted you to get into cryptocurrencies. I mean, I hear the skeptics say that they have no value. So what attracted you to cryptos?
Yeah, that's a good question. Well, whether they have value or not, people were trading them quite a bit. So, as a trader, at least like as a not a short-term trader, you really don't you really don't care that much about whether something is going to hold its value. You just care, does it have activity? Does it have liquidity? Are there counterparties? Can you make money off of it? So this was around 2020. I think everybody remember kind of that COVID year when everyone was locked up inside. So couldn't go out, couldn't do anything. So I was looking for kind of a hobby originally. Decided to get into the DeFi side of things. So I kind of skipped over all the centralized exchanges. Started trading stuff on the on-chain exchanges, the Dexus, and everything, the decentralized exchanges there. Kind of did what people call like MEV type trading, which is basically like the high frequency equivalent for decentralized trading. Started to do that just as a hobby. Just wanted to learn more about the technology, and then actually though. Kind of similar theme here is it was an early market, it was very inefficient, and it was easy to be profitable. So it kind of made sense. I said I should just kind of devote myself full time to trading this market. So yeah, kind of similar there, especially early on. I wasn't as deep in the kind of community, so I was trading a bunch of coins, and to be honest, still don't know what some of those coins did, but they go up, they go down. You can trade them, you can make money.
Uh-huh. So give us an example, like kind of a dive into a particular coins or types of trades, how long you held on to them. What did you look for when you entered a trade?
Yeah, that's a great question. I mean, basically, this was really interesting. A lot of trades you technically hold for 0 seconds, in the sense that so even higher than high frequency trading. But what you're looking for are basically mispricings. Say a coin trades on different venues. And the interesting thing is, all the venues are on the same, or a lot of times they'll be on the same blockchain. So you can do it different venues across different chains, but if you have one decentralized exchange on the same blockchain as another decentralized exchange, technically you can, and the prices are out of whack. Technically, you can arbitrage that in a single transaction. So you don't actually technically need, and this is even different than HFT, because you can do something similar where I buy Microsoft at NYSE and I sell it in NASDAQ because it's mispriced, but you still technically have to hold it and you have risk and the price could move, or you can sell it. The really interesting thing about this is you can do it in a single transaction. And you can arbitrage, you can arbitrage between prices and technically truly take no risk, besides maybe transaction costs, but like those are small. And if the price happens to go back in line before you get there, someone gets there before you just don't execute. And the really interesting thing is you actually don't, for a lot of these trades, you actually don't even need the capital to do them because in blockchain there's this concept of flash loans. So there are if you do something in a single transaction, you'll borrow money. Oftentimes for no interest or very low interest, you can borrow capital from some on-chain protocol. You can take that capital and you can do some operation with it, and as long as you return the capital by the end of the transaction, like there's that's the security, so you don't need to post collateral or anything like that. So it was kind of it's kind of a very interesting world, like a whole bunch of new things, which is kind of why I found it so fascinating.
So you're noticing, for example, XYZ token on one decentralized exchange is higher priced than that same token on a different decentralized exchange. And so what, you manually go through and you're able to get this flash loan and somehow combine all this in one
Yeah,
transaction,
yeah,
but you're on
exactly.
different dexes though, right?
You're on different dexes, but from the
Uh-huh.
same within the same transaction, you're able to because these are all just smart contracts, so you're able to actually
Mhm.
interact with multiple smart. Well, first of all, I should say you definitely not doing it manual.
Oh,
The
okay.
markets were that inefficient, but yeah, so to have a bot would do it,
Mhm,
but yeah,
mhm.
exactly. So you would write a bot, a program, and you would usually run your own smart contract on the chain, and that you'd send it, you'd scan constantly for these imbalances and try to be the first person to close them, and you could look at one dex or another dex, get a flash loan from somewhere else if you needed to, and so if it's higher, you buy on venue A, you sell on venue B. You sometimes also would be like a triangle trade or longer, right? So it might be usually the liquidity pools are paired with the two tokens, so you might go from trade token A to token B, and then token B to token C, and then token C back to token A, and you hope that you have more token A than you started with at the beginning. So it's the same kind of concept of arbitrage in financial markets, just kind of
Mhm.
done a different way.
I see. So was this operating while you were asleep? I mean, you had these bots running
Yeah, it's funny.
24/7.
That's the other challenging part of the crypto market is it's 24/7. So
Mhm.
when you're in regular traditional markets, at least like you said, you can sleep. The markets open, they close. When I was trading Turkey, that was like usually 2 a.m. to 10 a.m. So I did get used to needing alerts, and sometimes you wake up in the middle of the night because the P&L is bad and you get kind of the alert on your phone. But I did get used to automating stuff, at least to do stuff while I was asleep. But man, when it's 24/7, it's never a break, right? Like there's no Saturday afternoon to chill out. It's always P&L is running. So yeah, I think that's kind of the maybe one negative of the crypto space for people don't appreciate till they're in it.
And did you have to make frequent adjustments to your bots over time?
Oh no, I mean that's a great question. Yeah, it was when I started and this was like summer 2020. This was like right when like DeFi was like kind of taking off, so it was like very new. I think everyone was trying to figure out what was going on. And that was very different. And then obviously things got rapidly more competitive. More people came in. You would make adjustment. Yeah, you'd have to make adjustments to your bots. You'd have to look at different and even like the different dexes that were active were changing over time. Like this was ever at that point anyone could launch like a dex and attach some food token to it, and you get a bunch of liquidity there, and kind of do all kinds of crazy stuff. So yeah, you'd constantly kind of have to keep up with the market. The nice thing about like a good and bad thing about crypto is it moves very fast. It's very easy to set up like new exchange it, right? Like setting up a new exchange in traditional world is very difficult. Like there are regulators, there are people have to trust you. And in DeFi, right, setting up a new exchange is just hit a button and you got a new one. So yeah, you're constantly like have to kind of keep on top of things.
So I imagine you've traded on a range of dexes. What is your selection criteria for trusting a particular dex?
Yeah, that's a good question. it depends what you're doing on them. If you're swapping, the nice part if you're swapping is like you really don't have to deposit any money like on a decentralized exchange. You just you send your token in, you get your token out. There may be maybe right, like you can't. I guess there could be like malicious things in terms of like if it was really malicious, it could send you a fake swap or take one side of the swap and not send it out. But that'd be pretty rare. Like so, like no North Korean Dexus would be would be criteria one. If you're actually putting money into it, right, you're kind of trusting them over the longer term. So like if you're providing liquidity, right, because that's the other side of the equation is there are swappers and then there are people who actually deposit liquidity in one form or another. And if these are automated market makers, usually you know you you're in a pool and kind of the whole pool provides liquidity. That's a harder criteria, and a lot of times, like people who are providing liquidity in DeFi, it's very common, like call like liquidity mining, which means right, like there are usually the tokens of the DEX are going. So it'd almost be like if you were quoting at the CME and the CME was giving you stock in the CME for every day you were active. There. So, a big criteria there is like how much do I believe in the DEX itself is going to be around? Like, is this token going to be worth something? Is it worth being there? So yeah, I think those are like the major criteria. Now things have like moved on to like, well, I guess perp dexes are bigger. Those have right, like now you're dealing with leverage, and those have kind of their whole that's a whole other can of worms in terms of like what you're looking for there.
hmm I remember back in that time when I first got into it, the crazily high yields that I could get as a liquidity provider on Uniswap and some of the other ones. Were you ever tempted to be a liquidity provider, get those yields, or take positions short term or long term in any crypto?
Yeah, no, definitely. I mean, definitely took positions. Well, but well, all three, yes. So like the thing about crypto is you get into one thing and then you get into everything else. So yeah, definitely like for the first point, being a liquidity provider, I think there's definitely an art to it. Because like you said, you get the yields, but like what a lot of people don't realize is on the other side, you kind of have this position that isn't fixed, right? So especially like if it's a pool with like because usually the pools pair two tokens. So like let's say they pair like USD and Ethereum and like the values of those fluctuate. So as a liquidity provider, your positions are fluctuating with those and they're usually fluctuating in the wrong direction. Because if ETH goes down, right, like what are people going to do? They're going to sell ETH into the pool and USD is going to be going out of the pool. So you're as a liquidity provider, you're getting more ETH as it's going down and vice versa. When ETH is going up, you're losing, right? You're getting you're selling ETH. So I think a lot of times like those yields were somewhat misleading in the sense that like people, oh, like I got, whatever, 300% APR, but like I'm not seeing the other side of this, which is, I'm eating a lot of volatility on the wrong side. But I think like for a while, if you were intelligent about kind of actually measuring those things, I think very like not a ton of people were at the time, or even not like with the token emissions. Sometimes things were just during like those DeFi summer game days, like the tokens were. So some of the tokens had a lot of value that you're like, oh, why does this thing have any value? But it powered the ecosystem. And then to your point of short term or long term positions, yeah, definitely, will hunt around in crypto. I think from a fundamental perspective, especially when you're in it, you kind of know the teams, and like I feel like the biggest thing you bet on in crypto is like like if you're taking a longer term position, if you're not doing like arbitrage or liquidity providing or like short term trading, the biggest thing is just like the team behind it. I guess some is like the category, what you think is going to be big or not big, but usually if like teams execute well, the tokens tend to be good bets. And so when you're in crypto a bunch, you kind of get familiar with there's not really a ton of people in the industry, so okay, like these guys running this are like pretty legit, so tokens probably a good bet.
You mentioned the word perpetual. What are perpetuals or perps, and what do they offer the typical trader?
perps are a crypto-specific innovation, and it goes back to I guess technically somebody came up with the idea like way back in the 90s or 80s, but they never really got like that big. And I think there was like a number of implementation problems. But the idea with perpetual is it's a future that never expires. So typically we all know and love futures and trading futures, and those have obviously especially like financial futures have been a big part of the the traditional financial markets is where we all trade ES or NQ or the index futures instead of well, we still trade the underlying stocks, but right, it's a lot easier to trade the futures, especially if you want to do short-term swing trades or leverage or all that stuff. So perpetual is basically a future that never expires. So I think like well, originally it was BitMEX. I think it was introduced in 2016. So it was basically BitMEX wanted to run an exchange. They wanted to run a crypto exchange. They didn't actually want to deal with dollars going in or out, right? Because like then you have to have banking relationships and all that stuff, and that's fraught with all kinds of stuff. So there was just a Bitcoin only exchange. You could only deposit Bitcoin, but you could take levered bets on Bitcoin. Right. So that was like kind of their hook is like, okay, this is the first time you could really, I mean, you could kind of lever up at some of the other, but it was like messy. So you take levered bets on Bitcoin, and their big thing was you put Bitcoin as margin, and you could go lever long, lever short. And so it was huge. And so perpetual is basically, and that was what they offered. It was just an instrument where it never expires. So it's like a future. It trades linear. So Bitcoin goes up, Bitcoin goes down. There's a mark price to it. It aims to just give linear exposure. So if you're 50x levered on a perpetual, you have 50, and Bitcoin goes up 1%. You should be up 50%. Like that's the goal. Similar to future. The difference being, right, futures have fixed expiries. Perpetuals don't, because dealing with expiries are hard. People have to roll their positions. How do once you do settlement, okay, you have to like deliver stuff, mark stuff. So a perp just works by every hour, 8 hours, 24 hours. It depends like the specific exchange and their rules, but we'll call it every hour to every day. About there's a funding rate mechanism, and that basically works where the exchange will look at the price of the perp, or maybe we'll use some volume time weighted thing, and we'll look at the price of the underlying. We'll see the difference, and if the perp is more expensive than the underlying, then longs have to pay shorts. So right, like any derivative, there's equal amount of longs and shorts. So right, it's perfectly balanced. So $1 million long is open interest. There's $1 million long, $1 million short. It looks at the difference and it determines a funding rate. And it says, if the difference between the two is positive, we want to push the price down, right? Because like the goal is the perp should match, be as close to the spot price as possible. We want to push the price down. So therefore, longs are going to pay shorts, right? So it's more costly to be a long, the more dislocated it is going up, and kind of more attractive it is to be a short, and vice versa. If the price of the perp is below the price of the spot, then shorts pay long, right? Because like the market, you want to incentivize people to take the direction that pushes it back. And this has actually been like it's a kind of simple system, has been very, very successful. You put these funding things in, and perps do tend to track their underlying like pretty closely most of the time. As for the majors like Bitcoin, ETH, within a few basis points. So there's been a very successful system, and it's kind of allows a very simple way for traders to get leverage on a very wide variety of coins, and simple implement, and you don't have to worry about like expiries and stuff. So arguably, the biggest innovation that's actually come out of crypto in general.
Oh, wow. Interesting. So let's talk about the October 10th, 2025 crypto massacre, where it was the largest liquidation event ever in crypto history, with supposedly close to $20 billion liquidated in a single day. What on earth caused this? I mean, how could this happen?
I think a lot of people, nobody really knows for sure, to be honest. There's been a lot of speculating about what the underlying thing is, what broke, a lot of conspiracy theories. But what we do know is like you said, it was a massive amount of liquidations, largest ever. I mean, to be fair, crypto is a lot more expensive, a lot higher market cap than it was 4 years ago. So there were large liquidations then, but on a smaller market cap. But pretty large. People weren't expecting it. It wasn't on a ton of news. It was on some like rare earth tariff type thing. But the market just kind of broke down, and I think what happened is a lot of leverage had built up in the system from perps. So we're kind of going through a period where there's a lot of new dexes specifically focused on perps. So like perp dexes. So for a while it was spot dexes and kind of Uniswap and what we talked about earlier. Now kind of the technology is getting there where dexes can do perps. And then like a lot of dexes, if you're trading there, people kind of are getting tokens, tokens from the dex token, or expecting to get the token, or farming the airdrop. So there's a lot of synthetic leverage built up into the system where people who don't naturally have like a view on something would just we're taking positions on perps, sometimes very levered. Just take a position because I said, I'm hopefully going to get a token for this. So I don't know. I don't really know if Bitcoin's going to go up or down, but you know what? I'm going to open a 5x long on it and on this exchange, and they're probably going to have a token soon, and I'll get some tokens. And then a lot of people were doing, I'll open a 5x here and I'll short 5x here, and I'm a hedge and I'm on different exchanges, and I'm naturally balanced. I'm learning tokens on both, but the problem is yes, you are hedged, but your margins on two different clearinghouses. So in a situation where things move very fast, just because you have a profit over here doesn't mean you're not going to get liquidated over here. So a lot of leverage had built up into the system, and I think when things started going, and this was also true on centralized exchanges as well. I think like Binance had a huge amount of liquidations. When when it started unwinding, you kind of get this feedback loop where a lot of people were selling into a thinner and thinner book. A lot of order books just had no liquidity on one side, and then when that happens, there's technically something called like auto ADL or auto deleveraging, which was kind of really what shocked a lot of people, because this happens rare enough. It happens every couple of years. It's one of those things that's rare enough. People totally forget about it. It happens. People totally forget about it. It happens, and then it takes a while, and then people totally forget about it again, and then it happens, and you always have to relearn. It just never. People never remember it. So basically, the idea is on these perp dexes, one way they can support so much leverage. Is because they have these liquidation mechanisms where if there's ever too many people getting liquidated on one side, there's just not enough liquidity in the market to absorb it. What will happen is, because remember, this derivative that's always balanced, so there are, if the longs are getting liquidated, there are shorts on the other side. And so if there's no liquidity naturally in the market, what happens is they start force closing winners. A lot of people were kind of shocked because they didn't realize, they thought they were really in profit. Their positions got force closed, sometimes at prices that, they didn't expect, right? They thought, okay, Bitcoin, I'm short Bitcoin, it's at 102. Wait, what the hell? Like the system closed me out at, 109. Where's all my money? And then also going back to the people who are doing kind of those delta neutral trades, if you're getting force closed out on one side on one exchange, and you have you're short on one exchange, you're closed down, and you're long on another, you're not hedged anymore. So now you have like losses. So I think what the biggest takeaway from October 10th was a lot of people who thought they were safe from the perspective of maybe they're in these altcoins and they were comfortable with the leverage, or they were hedged between venues and they thought they could manage that. Ended up getting kind of burned, and typically in a lot of like financial stuff, it's not so much the amount of losses is when people feel like they're safe and they get burned, then they tend to be those tend to be worse for like financial markets. People get a lot more skittish.
But the thing is that weren't the perps, I mean, the perps are influenced by what happens in the spot market, right? Like at the big centralized exchanges. And I noticed that some of these well-known coins would go down 60, 70, 80% in
Oh
minutes.
yeah.
So what happened there? Did the market makers on the centralized exchanges just pull back suddenly? I mean, I don't understand why. How could they drop so much in such a short period of time? Uh, do the perps wag the dog, or or just
Yeah. So it seems like So two things there. One you touched on is one. There are most coins have market makers, and that's very typical. And for you have formal market making agreements. So if you're an altcoin and you're listing on Binance or whatever, you'll typically retain a market maker, and the model there is typically like what's called the call loan model. So the project will loan 1-2%, whatever, some small percent of the token supply to the market maker, and the market maker comes in and uses that to make sure there's always liquidity in the order book. And they kind of have requirements. They have to have 99% uptime, or within 99% of the time they have to have so much depth in the order book. But they have that 1% wiggle room. So they tend to use that 1% wiggle room during the periods kind of when when you need the most. So I think what happened is a lot of market makers just you know turned off. Like, even though they had obligations, they turned off. And who knows? People speculate, but like, you might just say, hey, like, this coin has way too much volatility. It's not worth for me to quote, you meet my quoting obligations right now. I'm just gonna, go offline. I've got other problems, great, because usually they're trading they're big trading firms. They trade other things. I got enough other problems. I'm just gonna turn off this system for, an hour or whatever. As long as I quote, 100 hours for the rest of the week, I'll be fine. I'll meet my obligations. So that was one, like you said. The other thing is on Binance, and a lot of the centralized exchanges, you can use your spot holding as collateral for the perps. So like you said, the kind of the tail can wag the dog there, because normally it should be the spot markets kind of determine the pricing on the perps. But what can happen is if somebody is putting and somebody's on Binance that has spot holdings, and they're using that as collateral on their perps, and their perps are underwater because they're leveraged on that. Binance is going to come in and say, okay, I'm liquidating your coins. And a lot of times I'm going to liquidate your most illiquid coins first, because I want to get that out of my system. Like, I don't want that collateral. Like, I want to push that collateral out of the door first. So yeah, I think that's what happened on a lot of coins, is that if a big whale got liquidated and happened to be holding that coin, like, you get slammed into the order book. Plus, right, no liquidity because the market makers are gone. So kind of recipe for
yeah.
disaster there.
So I noticed that on the hyper liquid DEX, one of the largest DEXs out there, on this day, their liquidity vault, one can invest in, had its largest single jump on that day when everyone gets liquidated. How can their vault, what is that exactly, and how can it go up so much on a day where everyone gets cleaned out?
Yeah, that's a good question. Well, I guess first thing to keep in mind is that these are zero sum markets. So anytime somebody's losing money, there's always somebody sitting on the other side, right? Like, if there's BTC perps, for every long there's a short. There's no actual BTC underneath it. So somebody's getting cleaned out. Somebody's making money. And it doesn't necessarily mean it's the vault, but it does mean, like, usually when people are losing, there's somebody who's winning on the other side, or always, and it just says who that is. So the vault in Hyperliquid is pretty interesting. It does two things. One, it's a market maker. So it originally started because, right, like, coins need liquidity when markets get bootstrapped, and so it was a kind of the standard market maker. And it was kind of interesting because it was the first time, like, you could really deposit into a market making strategy as, like, a retail user. Market makers tend to have very good returns, at least, like, in terms of risk adjusted returns, so it's pretty attractive. Over time, it's kind of stepped back from that role because other market makers have come into Hyperliquid. It's obviously been very successful. Other market makers have come in, have got kind of comfortable with the system, and they can kind of do a better job than, like, this relatively simple system that the vault was using. So they don't make a ton of markets anymore, but what they do is they provide a backstop for liquidation. So kind of going back to what we were talking about before, there's kind of this liquidation cascade when positions are liquidated on a hyperliquid specifically, and then both centralized exchanges and dexes work basically this way. At first, they'll take the liquidated position. They will try to close. You obviously got to close it out, so they'll try to sell it through the order book. If there's not enough liquidity in the order book, the next step is there's a backstop. In this case, it's the vault, and some other exchanges. It might be an insurance fund. FTX actually had an interesting model here, and they did other things wrong, obviously, but they had an interesting model here where they had like special backstop providers, but they all have like some sort of backstop provider because sometimes things won't be enough in the order book. That will step in and kind of absorb the liquidation at a pretty disadvantageous price. So it tends to be very profitable, right? Because you are absorbing kind of these liquidations that obviously they're not informed. They're not like informed traders. They're not telling you anything. So you're kind of sitting on the other side of liquidations. You're getting pretty good fills. The hyperliquid vault does do that. It's the only like system that does that. The problem is that the vault basically fills up or takes too many losses or can't absorb it even with its own collateral because it is just another trader in the system, can't absorb it in its own collateral. Then you go over to the ADL mechanism. So I think what was interesting about the hyper liquid vault, and I think the vault itself got liquidated a couple times that night. So its P&L was up and down. It was taking risk, right? Like it wasn't like just kind of printing money. It was the vault itself was taking risk. But what it did do, I think, is it got to absorb a lot of liquidations, both as they were coming, like on coins that before they kind of got totally wiped out. So it basically bought the bottom for a bunch of coins because it was kind of there, and then like when it kept going down, it got ADL'd out, and then as coins went back up, it also got some of the liquidations on the other side. So it's kind of when a lot of people are getting liquidated, you would expect like these systems to mostly do okay. It depends. A lot of chaos in the system, but yeah.
Mhm.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
So have you found any dexes which have, I imagine each dex has its own ADL parameters, right? And do you know of ones that are better than the others or that are, quote, more fair or have a better mechanism for doing this?
I mean, the reality is that all dexes have to socialize, or well, I'll say socialize loss or force loss at one point. So, like, the ultimate would be like this just didn't exist at all. But, like, unfortunately, just the mechanics. If you're going to have leverage in the system, you're going to have people who are insufficient. There are some moves that are so big that they're going to have insufficient capital to cover those moves. And, right, like, you do have to have some mechanism. The worst thing would be if you don't have it at all, and then the system could actually be insolvent. So even though like we'd all love it if that could never happen, like you do need it to exist. I mean, we're building a perp dex at our project, so like I am opinionated here about like I think our approach is right, but like we do think like the insurance fund model kind of makes sense, and that is one problem with like hyperliquid doesn't have an insurance fund. It has a vault, but the vault itself doesn't take loss. The vault will never take a fill that's a loss. It can take a loss if it fills and the price goes against it, but the vault itself will never actually take a loss into a liquidation. So if a liquidation happens, just too bad. The vault will pass it on and can just not fill it. And I think that's fine, but like the insurance fund model makes sense where you're building up reserves of capital based on fees being. The other thing is when there's a lot of volatility, there's a lot of fees, right? And like as those fees build up, yeah, like some should go to the exchange, but you should also, those are natural buffers for to kind of prevent these things. So if you can add a little bit more buffer room, I think that makes a lot of sense. Binance does have an insurance fund, and a lot of centralized exchanges. Perpdexes don't as much, but the problem with centralized exchanges, you really don't know what's happening. The rules aren't clear, and at least the nice part about Perpdexes are you can see what's happening, even if you disagree. You can see what's happening. The centralized exchange, there were a lot of undocumented things at Binance as well. Certain people had special ADL exemptions. And that didn't come out until that night. So it's kind of pick your poison, I guess.
Uh, uh, um, so what are you working on? You
Yeah.
mentioned that
So
you're working on something. Mhm.
yeah. So we have a project, Ambient Finance, which we still do run spot dexes on Ethereum based things, but now we're building a perp dex on a new chain Fogo, which is kind of optimized to be a trader specific chain, so much shorter block times, much higher scalability. The perp dex itself, I think we have an interesting model where we kind of separate the clearinghouse from the exchange part, and that often hasn't been done in crypto. The exchange and the clearinghouse tend to be unified into a single system, which has some advantages but also some disadvantages, especially like in this type of system. There's not like clear delineation on credit and insurance and things like that. And yeah, and just general working around kind of minimizing some of the toxic HFT behavior as well.
So you hope to accomplish kind of what are the main things? You mentioned insurance fund. And so tell us a little bit about that. I mean,
Oh yeah. So yeah, I'd say like we're focusing on a couple of things. So one is we're trying to separate out the exchange from the clearinghouse. So traditionally in crypto, the model in crypto has always been clearing, settlement, exchange all happen at the same place, and as we all know from like traditional finance, those roles tend to be separated out more, which is kind of in addition, right? You like one thing is you can have clear lines of responsibility. Okay, like where does stuff like insurance fund or like how do the rules work around that? And they're pretty clear layouts. You can build a very without being tied to the exchange. You can build kind of a much more security into the clearinghouse side. The other interesting thing is like other people once you have a clearinghouse. Well, one problem that's held back Herp Dexis is unlike like Spot Dexis, they can't interoperate kind of in the way what we were talking about before with like the arbitrage between exchanges. That's a lot harder. Perpdexes because you actually have to move the collateral over. Things don't seamlessly interoperate. But one interesting thing is if we have a clearinghouse that's kind of this base layer, even if we have an exchange vertical, other people can hook their exchanges into our clearinghouse. And so like ultimately, right, like the nice thing is people can experiment with different exchange models without having to build everything from scratch and kind of can innovate on that side. And, we can plug and play. And then the other thing we're trying to accomplish on the exchange side is being kind of avoiding some of the toxic HFT behavior that we talked about earlier in the interview. We're experimenting with kind of this. We've kind of been working on it with jump trading, which obviously a very big HFT firm is like huge in both crypto and traditional markets, but it's called what we call dual flow batch auction, similar to club. It's pretty similar to traditional order book, but it tries to use these kind of micro batch auctions to where takers compete more on price rather than speed. So I think especially in a blockchain context, that makes sense because blocks can't be faster than a certain speed. And we think like basically that takes a lot of the predatory trading out of the market, makes things a lot easier for ordinary traders to if not make money, makes it harder for them to lose money at the very least. So yeah, I think we're just trying to kind of reinvent kind of a lot of the things in perpdex space.
did you have any takeaways from the October 10th massacre and what happened on, say, Hyperliquid and others, kind of new lessons that you can incorporate into your system? And if so, was there kind of any takeaways that you got?
Yeah, I mean, I think the biggest takeaway is like number one, like transparency about stuff ahead of time. And that's if whatever the rules are, if they're not clear ahead of time, then people are going to be unhappy. And I think even some of the perp dexes had unexpected behavior, and the documentation around them wasn't fantastic. Maybe if they were documented. And the other thing about like a lot of these perp dexes are they're closed source, so that's something we're also trying to avoid. So I don't know like how decentralized you can be. If you're not open source, right? Because ultimately, if you're open source, everyone can check the code to see what happens. But whether it was centralized exchanges or decentralized exchanges, I definitely think the biggest takeaway is just when things weren't transparent or they're ambiguous or behavior didn't quite match up with what people said they did. That hurts trust in the system, and that hurts your brand long term.
At least one perp dex I found allows investors to actually invest in an insurance fund and to take the other side of that kind of trade and earn yield from that. Do you anticipate offering any type of ability for people to invest in an insurance fund and take the more opposite side of the trade?
Yeah, we actually think that's a pretty interesting model. And we also think, one thing that we're doing, a lot of perp dexes basically live on like siloed systems. So they're not technically on a blockchain. They settle to a blockchain, but a lot of times the system runs off chain on a server. So we were trying to put all of our systems very, very on chain. So even something like an insurance, like we would be able to offer that. We could even take it a step further and say, okay, you can tokenize shares in the insurance fund, potentially use that as collateral for, for other things in the DeFi ecosystem, potentially tranche it out. So somebody says, you know what, I want to be, I want to be, once the safer part, if someone else takes the first 10% of losses on the insurance fund, and I'll do the 90% and get lower yields. So you can kind of turn those into the DeFi Legos that we all know and love.
Oh, great. And when do you anticipate being able to launch your new platform for traders to trade?
Yeah, we should be out end of this year, if not very early next year.
Okay, great. And just a couple other questions before we wrap up. What are your thoughts on real world assets and the tokenization? Is it a lot of hype, or is this the future of finance? And then the last part would be convertibility of crypto in the crypto sphere to be able to use it in day-to-day life. Like, how can I use it with a debit card? Can I,
Yeah.
of any way that we can practically and easily use it on a day-to-day basis?
Pay my mortgage with it.
Exactly.
Yeah, let me. I guess I'll answer the second question. I'll go backwards. Yeah, I think the biggest thing is getting integration into the banking system. There's a lot of interesting things now with like crypto cards and a lot of the rails, and obviously the regulatory climate has changed. At least in the U.S., I think other places. So banks are, I can't tell you, like 2 years ago, even just being a developer, like a developer, right? Like like our banks would ask you for just having a checking account for your company was risky. But now I think the financial system kind of wants to interoperate with crypto and is figuring out how to do that. And obviously things in traditional finance don't move quick. There are lots of compliance things, but once you kind of get moving, the ship is large. So once you just got to get it moving in the right direction. I think we're moving there now. And that I guess kind of ties in with real world assets as well. I think for a while, those weren't on the blockchain because it was just way too much regulatory risk. That the kind of regulators who are actually responsible for those real world assets would say like, no way, to any type of tokenization. I think it's really useful. Like crypto rails are fantastic this is why stable coins are so big, because they're just easy to send, easy to store, easy to move around. If you bring that same type of convenience and mobility and low friction to stocks or bonds or other types of assets, I don't see why those aren't like strictly better. It'd be how much of a pain right now is it to move stocks between brokerages versus just opening your wallet, send it here to there. So yeah, I think right, like once it gets off the ground, it should I think take a lot of market share quickly.
Great. Well, Doug, I'd like to thank you for coming on Chat with Traders.
Thanks, Ian. It was great.
Yeah. So how can our listeners reach you, and what's your website for your new platform?
Yeah. So they can reach us. The biggest, I guess, easiest way is follow us on Twitter. So we're at Ambient Finance, at Ambient_finance, and our website is ambient.finance. And
Fantastic.
that's where our platform will be.
Great. Thanks for coming.
Great. Thanks, Ian.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.